Good afternoon, everyone. Robert Reaburn here from Life Pro Asset Management. Hope that everyone's having a great week so far and they enjoyed their long weekend here as we celebrated 4th of July. Certainly a unique 4th of July given the ongoing disruptions taking place as a result of COVID-19, but I'm sure that everyone had a great time. The weather was definitely great across the country. So without further ado, let's go ahead and get started. This week we really want to focus on a few things. And one is, despite the ongoing consolidation, intermittent with some rallies here in the overall stock market, we want to make sure that we're staying focused on quality because that's what's ultimately going to lead to what we call durable long-term performance over the long run. And today, the message really is that we want to keep things simple. I think a lot of the times, we go through these weekly reports and we go through, a chart here and a chart there. And the reality is right now, from a risk on, risk off perspective, the Federal Reserve is flooding the economy with cheap money. And sometimes it's as easy as saying the Fed is printing money, buy stocks. We can go through 1,000 different scenarios, but the reality is that the Fed is trying to push asset prices higher. They're the buyer of last resort. They're the largest buyer on the planet, and therefore we want to make sure that we're not trying to be heroes out there and fight against the largest purchaser on the planet. So sometimes it's just that simple. But in addition to that, really what we're going to show here today is that the market symptoms remain supportive. More and more stocks are participating in the rally. We do have some decline in the number of stocks over their 50-day moving average. Nevertheless, that is a sign of consolidation, not a sign of a backward check. And then, of course, stock picking remains critical. And we'll go through and really understand what happened in 2009 through 2015 and beyond, and how that pertains to today. The stocks that were most impacted by the COVID downturn, comparing them by the stocks most impacted by the global financial crisis, and how that can give us clues as to how we want to position the portfolio for the weeks, months, and years ahead. So overall, when we look at the macro landscape, there's a few things we want to consider here. The macro landscape is kind of weak, and that's okay if you're in stocks. And one of the things that we've learned over the years of working on Wall Street is that liquidity matters more than the economy. And that may sound counterintuitive to a lot of first-time investors or even investors that don't necessarily do this full-time. But liquidity is the most important thing when we're looking at how we want to assess risk, where we want to go long risk versus short risk. And when we look at the three key liquidity factors right now, not only are they improving, but they're in very strong shape. So when we look at money supply continues to increase exponentially, backed by very low interest rates, in fact, record low interest rates. And ultimately, that's feeding into a very healthy credit market where companies, regardless if those companies are in terrible shape or in good shape, they have access to money. And if you remember last week, we talked about the rise of zombie companies where their cost of capital is more than their return on equity. Those companies are able to raise money cheap enough to stay alive, but not cheap enough where they can generate a positive spread between their return on equity and cost of capital and push the stock price higher. So we want to avoid those types of companies. Quantitatively speaking, market breadth remains strong. Investor sentiment remains bearish. Now, some of the short-term surveys are ticking up in terms of sentiment, but overall, we look at not what people say, but what are people doing, and the amount of cash that's sitting on the sidelines right now is near a record high. So when we look at that type of positioning, we look at the overall average performance of hedge funds and mutual funds and how they're trailing the market. Ultimately, as we get into the second half of the year, that creates a performance chase where that money will be dragged back into the market. So as Wayne Gretzky says, we want to skate to where the puck is going, not to where it is today. And if that money comes back into the market, that will push asset prices higher. And the other thing we will say is, from an investor positioning standpoint, the number of shorts, the overall market remains net short. And so When that happens, you want to be on the other side of the trade. So just something to consider there. Economically speaking, the labor market, and overall economic activity are improving, but they're still at a very low level, which is good from a rate of change standpoint. But given some of the second wave concerns we're seeing with COVID, we're likely to see those numbers tamp down a little bit here in the second half of July. So when we start to get those reports in August, probably see a tick down in there, but that's okay because liquidity is on our side. Inflation remains low. When inflation remains low, we know that liquidity is going to remain high because the Fed's not going to be forced to raise interest rates. And one of the most important economic factors that is in very good shape is that inventories are near record lows. So, in other words, companies are not going to be stuck with inventories that they have to write down. And of course, it just need a moderate level of improvement in overall demand for each individual company to go through and issue new orders. Performance-wise, we continue to click along nicely here. Year-to-date, as of July 8th, we are up just around 44.7% versus minus 2.65% here for the S&P 500. That's led to outperformance of around 47.35% after fees. So we are happy with that performance, and when we look at going back to inception, our investors are up around 135.79% versus 40.49% for the S&P 500. That has led to outperformance after fees of around 95.3%. Now, of course, we always say this every week is like for all our new investors, our existing investors, each day is a new day. And so we have to make sure that we're able to maintain new performance going forward, and rest assured that is what we are doing. If we have to make shifts in the portfolio at some point, we will. The biggest risk to the portfolios right now is not so much the market going down, but some sort of junk asset rotation that we see going into the airlines, going into the cruise liners, the banks. Those are areas we don't have exposure right now. So if there was that type of rotation, we would want to look for the best companies in those areas, take some exposure, but not completely remove our exposure from where we are today, because the companies we're in today, we believe, are going to dominate market performance over the next 5 years. So that's just a quick snapshot here. One quick note, says July 1st down here. This should say July 6th. July 8th. So everything here is as of July 8th of 2020. In terms of market breadth, we see here in terms of advancers versus decliners continue to hit new highs relative to where the lows were back in March. That is a positive symptom. One caveat we would say is the percentage of stocks above their 50-day moving average has ticked down a little bit, and that is very emblematic of a summer consolidation in the market. Very strong move in the spring. Just like a sprinter, sometimes you need to stop, catch your breath before you sort of move on to the next leg higher. In 2009, the same thing happened. We had a really strong move from March through mid-June. Stocks consolidated and then proceeded to move higher into the end of the year. We think the same kind of playbook is moving here, and that's why stock selection is so critical this time around. So when we look at where we're positioned right now, we like how we're positioned. We think we can continue to make gains as the market consolidates. In terms of the credit markets, credit risk just continues to decline. And this is by far and away the result of the Federal Reserve coming in and removing that solvency risk from the credit market. So basically becoming the backstop of last resort for both good companies and bad companies alike. When credit markets go through a heart attack like they did in March, the Fed can't pick and choose who they're going to support. They have to provide blanket support. This can create political issues, but from a market standpoint, we don't care about that. We only care about how it's going to impact asset prices. And so this is an extremely positive symptom for risk assets as we head into the second half of 2020. Most important chart probably today to look at is money supply. Sometimes it is as simple as just saying, you know what, the Fed is the buyer of last resort of all assets across the planet. When they are printing money, when their objective is to push asset prices higher to build investor confidence and build consumer confidence, don't fight it. Just go with it. And then on top of that, stay focused on quality companies that are also going to benefit. In 2008, we heard about how much the Federal Reserve's balance sheet expanded, how much money was being printed. This is the tick up that happened. I mean, if we pulled this chart back, it would look like a big move at the time. But look at this move compared to this move. So the simple question to be had here, or to be asked, is in 2009, when the Fed printed money right after a big recession, what happened to stocks? They moved higher. Despite all the hate, despite all the worries about the banks and everything else, what do you think will happen this time in terms of the magnitude of the move in the stock market versus 2009, when the money supply is doing this over here to the right versus this? You know, sometimes it's just as simple as looking at this. Sometimes a picture just says 1,000 words. So we do think that stocks are very well positioned here. In terms of the actual economy here, we saw a very nice recovery here in the service sector. Service sector makes up over 70% of U.S. GDP. Certainly doesn't affect how we steer portfolios, but it is certainly nice to see that the U.S. consumer is a lot more durable than I think a lot of people out there feared. And so we are paying attention to this. New orders up strongly. That is emblematic of the fact that inventories remain extremely lean here through the summer months. So any uptick in demand causes a big spike up in new orders. And then, of course, stock picking does matter. You know, that's our bread and butter. We focus on companies that are in areas of long-term secular growth, that have solid balance sheets, and our overall position to perform well in both weak economies and good economies. And sometimes one thing that can happen during a recovery is that investors can be tempted to chase the junk. And what we wanted to show here was the performance of weak balance sheet companies versus strong balance sheet companies. You can see the underperformance is over 30%. So when we look at our performance and why we've been able to outperform the market just in 2020 by over 40%, and why we are up 44% in 2020, the number one factor is to look at the composition of the companies we're invested in, the composition of their balance sheets versus those companies that are underperforming. Our companies have low levels of debt, high revenue growth, high free cash flow conversion rates, and solid management teams. These companies that are underperforming have high debt, low growth, and management teams with a mixed track record. And so secular growth is super important. So one chart we came across this week that I thought sort of really illustrated the impact of secular growth versus companies that are not positioned correctly is we look at retail sales in Europe for companies that have what we call an online sales channel, so what's called an omni-channel, where consumers can buy offline or online. You can see here the strong growth in online sales versus what happened, obviously, brick and mortar. So it's just super important that companies are staying with the times. They are offering consumers different ways to access their products and services. And so that's a no-brainer at this point. We're in 2020. The internet's been around for over 25 years. If your company that you're invested in is still working on it, it's time to sell it, because that is a management team that strictly is not executing and is not living in reality. So secular growth, super important. Quality, super important. Quality gives us time. So a lot of times when we buy a stock, maybe our timing's off by a month or two, and then it inflects higher. We saw that with Snap. We saw that with TJX. These are different stocks that sometimes you have to wait. And if you have to wait, you want to make sure there's balance sheet strength there. Otherwise, there can be a solvency issue. So again, just quality is super important. In regard to valuation, absolutely stocks have moved higher. But one thing we would note is, of course, valuation is not an absolute game. It's a relative game. And so what we have to say is if we don't own stocks because we think they're expensive, well, where are we putting our money? We either have to put our money in cash, which is offering 0% interest rates. We have to put our money in bonds, which are at all-time low interest rates, all-time high prices. And then we have to see, well, how do bonds compare to stocks? And you can see here, when you take the S&P 500 dividend yield, you subtract the 10-year treasury yield by that, it's near all-time highs. So again, one of the things we would note is that bonds are extremely expensive versus stocks, and those are the two most liquid asset classes out there. Secondly, the amount of negative yielding debt in the world right now is close to $15 trillion. So in other words, at an all-time high. The impact of that, when you have all of Europe, all of Japan in negative yielding debt, is that it pins down U.S. interest rates. It's very hard for U.S. interest rates to escape that 1%, so that 1% level, when all of this money overseas is buying positive yielding debt in the U.S. and thereby pinning it down. So again, when we look at what's happening in the debt market, we really do like what's taking place in the stock market. So overall, investors continue to hate this bull market. We see it with cash levels. We see it with activity as it relates to shorting the market. That is a positive thing when you're long stocks. And so we continue to love that activity. We want to keep it simple. Cheap money's flooding the economy. Don't fight the Fed. Thirdly, U.S. consumer is beginning to recover, believe it or not. Despite all of the concerns related to a second wave and high unemployment, U.S. consumers entered this recession in fantastic shape, and they're just waiting to spend money. And the savings rates is very high. So again, we have a lot of dry powder there to increase spending levels. And above all else, stock selection remains critical because we want to stick with the leaders, areas of secular growth, companies that are good, getting better, strong balance sheets, and have the firepower to capture market share and increase their sales growth. So overall, things remain solid, and we're positioned for a continued second half recovery here. So if anyone has any questions, our phone number is 888-543-3776. You can reach me directly at 858-354-5114. And again, thank you for your business, your support, your guidance. And if anyone has any questions, please don't hesitate to ask. Thanks again, and have a fantastic week.